Hey, welcome back. This is Tarafdar back with a brand new video. Today's topic is about your fundability score. So there's two sets of fundability scores today, okay? We're going to talk about the personal fundability score and we're going to talk about the business fundability score. And each of these criterias will vary. So let's start with the personal fundability score. Now most of you guys are probably wondering what that means. And before I forget, before we start and get deep into the topic, I'd like for you guys to remember, if you're new to this channel, don't forget to subscribe and turn that bell icon on. So every time there's a new informative video like this, you will be first to be notified. On that side, topic. So fundability score, what is that? Fundability score is essentially how you rank among your peers and individuals who are in your age group and your category and your ethnicity and your credit experience and history, as well as your income, and how you rank to get the funding that you're looking for, and how likely is that you're going to get the top tier financing, or maybe you're going to get the lower end financing. Now, speaking of that law, right, they cannot just simply take away funding just because you're a certain nature, race, or color. That's actually illegal. But what happens is there are statistics that go into the fact of calculating your fundability score, and we have to think about how much of that statistic really plays against us and how much of that actually works in our favor. So let's go ahead and discover some of these things. Let's talk about what they are and how you can take advantage of this so that you can actually get the funding that you're looking for. So on the personal side, the fundability score, there's 5 factors, right? There's the credit score, which you have to know. Obviously, that plays a big factor. Your credit history, which is what's the oldest accounts, are they seasoned, how's the payments looking, right? So once again, credit score, credit history. The third element I would say is your relationship with those creditors. You may be wondering, well, no underwriting system will actually go out there and reach to those individual creditors on your behalf to see whether or not you are a good payee, right? Like if you're paying on time. That's not how it's calculated. It's calculated based on if you have any missed payments, right? If you're on time, what's your debt utilization ratio, and all these type of factors. So that's the third element on your fundability score on a personal level. Then you have your fourth element, which is the likelihood of default, right? A lot of people don't think about that. Just because you are good at handling your credit, right? And just because you have a good history, for instance, and have a sustainable of credit building efforts, doesn't necessarily de-risk the whole situation. So the likelihood of default is calculated based on 2 things. Number one, based on your previous history. Let's go back 7 years, right? And the archive of those 7 years of credit history. What are some of the ways that they can identify that you almost maxed out your situation? And how long did it take you on that score to put the balances down, right? Typically speaking, on a minimum payment term. So for instance, let's say if you have a $5,000 limit and you were at $4,800 in the past 3 years, and you just recently paid down your debts, it took you a good 3 years to pay it down, right? So when you have situations like that, the default situation is pretty much close by, because you can default anytime. You can get bad debt. The account can go negative. You can go over your limit because of the interest charges, and there's certain things like that. So you have to think about that, right? So a lot of people think, hey, if I have a good credit score, if I have a good payment history, if I have a good accounts on there, if I have a solid authorized users, I should be able to get a lot of funding. Mind you, it's true. You can get a lot of funding with that. There's nothing wrong with that. But before you get to an underwriter, or let's say if you submit your file online for a credit card application or funding, isn't it better that you know your fundability score? Isn't it better that you kind of understand, hey, what is the likelihood of me getting approved, right? There's so many factors playing in, but why not increase your chances of approval? So the likelihood of default is calculated like that. On your history, how close were you to the maxed out of your limits, and how long did it take you to pay it off? So that's one of those things. That's the fourth element. And then finally, the fifth element on your personal fundability score would be the overall limit and balance that you're playing with. For instance, if you have a $10,000 limit, the duration of that $10,000 limit, how long has it been? Have you been in with that creditor for at least a year minimum, which is 12 months? And it's not a question of 10,000 recently. So a lot of people think, hey, if I have 10K with an approved limit recently, I can just plug in and get a lot of money. That's not the case. Your 10K limit has to be seasoned for at least a minimum of 6 months, right? A lot of people said a year. Even myself in the past I said a year, but those circumstances have changed. you actually have to have a minimum limit of $10,000 for a minimum of 6 months. Once you satisfy that, then we can move on beyond the fundability score. So again, just to go over everything: your credit score, your history, your payments, like the relationships with that, your likelihood of default, which we calculated based on the maxed out debt to how long it'll take to pay it off, and your relationship on the highest limit. How long has it been? And we said a minimum of 6 months is a requirement. So those are the 5 elements of your personal fundability score. You calculate that and you get a score close to 100, right? For each of those items, calculated out of 20, right? So because 5 times 20 gives you 100. Now, obviously, the higher your score, the closer to the 20. The higher the history, the closer to your 20. Ideal history to calculate that is if you have a good history of minimum 5 years, right? Anything beyond that is gravy. If you have anything less than 3 years, then your score on that 20 goes below 14. So that's just a calculation I want you guys to play with. So the closer you are to the 100 mark, right, the more likelihood of the ultimate funding that you can get. So keep that in mind. That's for your business. On your personal level. Now let's go to the business side. On the business side, it's very similar. Okay, but one thing plays very crucially in that business side. We talked about your score, your business credit score, your paydex. That's a must. The creditors and the strength of those creditors. How are they? And what I mean by strength of these creditors is, are they known? Are they major Fortune 500 companies? Are they hard to qualify for? Do they scout out and see guarantees? The harder the creditor that you have on your credit reports, and you have established relationships and accounts with them, and you have a seasoned history with them, the likelihood of you getting funding is higher with institutional funds. Like, for example, if you want to get a SBA loan or a line of credit with a major institution or a credit union. So that's one of those things, right? So we talked about score, we talked about the relationships, we also talked about payment history. So your credit scores will determine that on whether or not you're actually paying on time and if you're maintaining that properly, right? So that's there. Fourth element, the likelihood of default, the same calculation goes into play, right? Of those limits, if you were to max it out, or if you were close to maxing it out, how long did it take you to pay it off? Now, for instance, if you never got close to maxing it out, then that calculation is going to be a complete 20 because it shows that you're actually maintaining it well, and the likelihood of default is not even questionable. So that's the fact. And then final element, it's almost similar to your personal side, where which is your highest limit and how long have you had it. But instead of which is your highest limit and how long have you had it, in a business fundability score, let's think about the business income that you have. We talked about debt servicing ratio yesterday, right? But the business income that you have will help you kind of qualify for funding. For instance, if you have a certain level of income and your business income supports the debt that you're going to take on, in addition to all those fundability factors, then it's perfect, right? And how do you how do you score out of the 20 your business income? So the goal is, if you have, let's say you're aiming for borrowing $100,000, and using yesterday's example, let's say you're borrowing at 12%. And we do a maxed out scenario, which is 12% would be 1% a month, and 100K, that's $1,000 a month, in addition to principal payments, which would be, let's say, at 1%, which is $1,000 a month. Now you're looking at $2,000 a month of cash flow, free cash flow, times 1.5 to 2. Why do you want times 1.5? It's because you want a buffer, right? Just because you have $2,000 a month to exact the maximum debt servicing doesn't necessarily mean that you get approved. That means that you'll be having no cash left at the end of the day if you were to max out that credit card or a line of credit. So you want to have at least $3,000 a month of cash flow freely that supports the maxed out debt situation that you're trying to borrow. So based on that, if you have your cash flow, you rate it based on 20. So you do some fractions. You look at the calculation, you say, out of the 20, how close am I with the maxed out minimum payment, right? Can I sustain it? And if so, do I have a buffer? So if you have 1.5 times the minimum payment, you're automatically scored at 20. Anything less than that, your score starts decreasing. So that's how you calculate your business's fundability score. So I want you guys to kind of look into those factors before you apply for creditors, before you start going through underwriting, before you pick up the phone to talk to your banks. This knowledge is very critical for you, because once you understand that, you can go ahead and apply to any types of funding with a clear understanding, okay, of what are some of the things that you'd qualify for and how you rank amongst everything else when it comes to borrowing, right? And the reason for borrowing, obviously. So remember, debt is to build your wealth. It's not to go into further and further and further debt and in the hole and try to find systems and tweaks to get out of that situation. That doesn't really help you, right? And I teach that in the Ultimate Personal Credit Mastery, by the way. And the course is actually below this description. So go ahead and look at that. Also, if you're into business and you're trying to build your business, you want to make the maxed out situation for your business, really improve the financial viability of your business, you want to take the Ultimate Business Credit Mastery. It's actually, the link is below on the description with the Ultimate Personal Credit Mastery. If you guys want a bundle, we can work a price out. Don't worry about that. So just leave a comment below that, hey, look, Ali, I'm interested in doing both because I want to take my personal and business to the next level. So I hope this video was helpful. Once again, if you haven't subscribed and you're at this point, don't forget to subscribe and turn that bell icon on so you can get more informative and educational video such as this one. With that said and done, your guide and mentor, Ali Tarafdar. See you guys next time. Bye for now.